It seems like every week we get news as investors that scares us and that they're trying to push us out of the market. Just like last week when Michael Burry, the guy who successfully predicted the 2008 recession, sold his entire stock portfolio. Which is kind of weird because he never really tries to time the market unless there is a really good reason for it. Last week we also had Jerome Powell absolutely crashing the stock markets by telling us that bringing down inflation will cause people to lose their jobs. And this week we had a legendary investor, Jeremy Grantham, telling us that we are now in the final stage of the Superbubble. And that sounds terrifying. If you are unsure about Jeremy Grantham then I can tell you that he is the guy who successfully predicted the asset bubble in Japan in the 80s. He also predicted the dot-com bubble, and he also predicted the Great Recession in 2008. So he is obviously quite good at predicting recessions. According to him, we have only entered the final stage of the Superbubble 3 times in the last century. And that is where we are now. The first time was during the major crash in 1929. The second time was during the stock market crash in 1973 to 74. And the third time was during the dot-com bubble. And that one was a bit more mild in comparison to the other two. If you don't know what a superbubble is, then don't worry, because I'm going to talk about that in today's video. I'm also going to talk about how they are formed, how they start, and then I'm also going to talk about what I'm personally going to do with my own stock portfolio. So watch the video and learn all about that. Please remember that if you do like today's video, then press the like button below the video and make sure to subscribe to my channel if you want to see more videos like this one in the future. With that being said, then let's start talking about how superbubbles are formed. When looking at the stock market, well then does the stock market do its thing for about 85% of the time. It goes up and down in value, but over time it basically increasing. So it is working like it should 85% of the time. But the other 15% is what really defines what happens in the market, because this is when the investors are making the worst decisions. Out of those 15%, well then 12% of the time we have investors who's just buying all things randomly and they don't really care about the value of what they buy. It can be argued that we have gone through this time with people making major investments into NFTs, cryptos, but also investing into stocks with ridiculous high PE values. The other 3% of the time is when investors are in extreme fear. They start selling every single stock they have and they enter a panic mode. Today the stock market is trading on an average PE ratio of roughly 20, but it should actually be much closer to 15. And certain times in history, the PE ratio on average have actually been really close to 0. Just try to imagine what would happen to investors if that became a reality again. The point that Jeremy is trying to make is that the times of extreme fear and of extreme greed are the most dangerous times to be an investor. And that is exactly what we're going through right now. So let's start talking about what a superbubble is and how it starts. The superbubble is usually thanks to the interest rates being kept too low for too long. And that is exactly when investors start to get greedy and invest into things without any real value. So that is phase 1, and we can say that we've definitely been there already. So event 2 is when a setback occurs, either political or globally. So this is when investors, they start to think about that maybe the stock market is not going to go up forever. And this is when they start selling their stocks. And phase 2 is definitely something that we've also already seen here in 2022. So then we move on to phase number 3. And this is basically when investors, they start to think that the stock market might be able to recover and reach all new time highs again. This is similar to what we've seen during the last couple of months. But it's also similar to people right now saying that the economy is doing just fine and that there's nothing to worry about, which is clearly not true. We usually see that stocks reach new all-time highs very slowly, and that is because investors, they usually think, okay, this stock can't keep on going up forever. It must go down at some point in time. But recently we've just seen stocks hit new all-time highs all the time. And according to Jeremy, well then these signals, they keep on repeating themselves until a recession comes. And one thing is sure, and that is every time we've seen these signals before, a major recession has come. So here is what I'm personally going to do about my own investment portfolio. Even though everything right now is pointing towards a recession, then I actually don't plan on selling any of my stocks. I actually plan on doing the opposite, because I keep on buying into the market every single month, because I do believe that right now is the best time to set yourself up financially for the future. I don't know if the market is going to go any further down, but I do believe that there is a very high probability that it will. But I also believe that in 10 to 15 years from now, then have the stock market reach an all new time high again. And that is exactly what I'm investing for. I'm a long-term investor, and I do believe that in the long term, then the stock market gets to a new all-time high. And that is what I'm investing for and hoping for. So to sum it up, well, then I basically keep on investing into the same stocks as I usually do. I am investing into the S&P 500 index every single month, and I plan to continue doing that. I hope that you enjoyed today's video. If you did, then please press the like button below the video and make sure to subscribe to my channel if you want to see more videos like this one in the future. Thank you for watching, and see you in the next one.